Welcome back friends. Today we are going to discuss about setting up of contingencies funds and tax planning. Let's begin with contingencies funds, another key aspect of personal financial planning. Friends, everything depends on the financial well-being of the family. When the inflows are on track there is nothing to bother. However, you have to think about any kind of uncertainty and requirement of funds in case of emergencies as well as in case of sudden stop in the inflows of funds. Anything adverse can happen at any given time. We see businesses lose the shine as sometimes the inflows are affected due to some unexpected happening. Just see the example of recent corona pandemic. Aviation, hospitality and tourism are the most affected industries and lot of people in these sectors lost their jobs all of sudden. Otherwise also, we see several ups and downs in businesses around us. In fact, that's the reason why we should think about contingencies funds. The thumb rule for setting of contingencies funds is 6 times your monthly income. It is advisable to keep these funds in liquid assets, preferably in liquid funds, so that it can be made available at any given point of time. Now again this is also a person specific and hence someone may feel that 6 times never seems sufficient provisioning. So in case the job is uncertain or there are any other concerns related to earnings, it is advisable to keep more amount in the contingencies funds. However, in such cases, the contingencies funds can be split in two parts and one of the same will be kept in liquid assets and the other will be invested in any other debt fund considering the investment horizon of 6 months to 1 year, so that this amount can fetch you better returns than that of liquid fund. So that's the way of creating contingencies fund. Now let's discuss about the tax planning, another important part in the financial planning. Personal taxation means broadly speaking income tax and it is necessary to understand the basics, so that you can evaluate your taxable income and tax, which is one more critical outflow from the income. There are various sources or heads of income. But, the income mainly can be considered either from business or from the salary. Now there are certain deductions available from these different sources of income. I am going to discuss today on the deductions, which are main ones and are usually applicable to most of the people. For a salaried class, usually the employer works out applicable income tax and the same is deducted upfront as TDS on salary. So in case you are salaried, you get the assistance in computation of your income and tax from your employer. Whereas, in case of business income, you may hire tax consultant or advisor to get the necessary assistance. Here, the responsibility of paying taxes is yours, where you have to pay advance taxes in installments, based on your estimated income. These installments are payable periodically at stipulated time. Though you take assistance from consultant or advisor, it is always good to know the basics as well. So, let's discuss about the majorly considered deductions and in that the first and foremost is the deductions under Section 80. Your investments in various financial products and some of the expenses are eligible for the deduction from your income under Section 80, while deriving your taxable income. Let's understand this now in more details. The deductions eligible under Section 80C are your Provident Fund or Superannuation Fund deposit, in case you are salaried. Then, your PPF deposit, life insurance premium paid for you as well as for your spouse or children, 5 years fixed deposit in banks categorized under Section 80C, investment in national savings certificates of post office, then tuition fees paid for up to 2 children, principal component of repayment of your house loan installments, your investments in units of ALSS, that is equity-linked savings scheme of any mutual fund. As mentioned, all these investments and expenses are to be deducted from your total income to derive your taxable income. However, maximum limit to claim these deductions altogether under ATC is Rs 1,50,000 from the income in a financial year 2021 and 21-22. The next is deductions under Section 80D. You can avail this deduction on premium paid towards medical insurance for self, spouse, dependent parents and children. The applicable limit for this deduction is Rs 25,000 for the financial year 2021 and 21-22. This limit is extended to Rs 50,000 if the parents are below 60 years. Otherwise, when the parents are above 60 years, the limit is extended to Rs 75,000. Also, within the above prescribed limit, you can avail the deduction of Rs 5,000 for any payments made towards preventive health checkup. However, the overall limit for this deduction is Rs 25,000 or 50,000 or 75,000 as mentioned earlier, and health checkup charges should be inclusive of the prescribed limit. The next deduction is under Section 80A, which pertains to interest payment on the education loan taken for self, spouse or children. This deduction can be availed for 8 years starting from the year in which you start repayment of the loan. There is no maximum limit for this deduction. However, you need to submit the bank certificate, in which the principal and interest components in the repayment amount is specified, and the deduction under Section 80A is allowed for the interest component paid, whereas the principal component is eligible for deduction under Section 80C. Further, the Section 80G pertains to donations. However, all donations are not eligible for deductions. There are certain specified funds, which qualify for 100% deductions, such as donations to National Defense Fund, Prime Minister's National Relief Fund, National Illness Assistance Fund, etc., etc. Also, there are some other specified funds, which qualify for 50% deduction, such as Jawaharlal Nehru Memorial Fund, Prime Minister's Drought Relief Fund, Rajiv Gandhi Foundation, etc., etc. Then there is one more deduction under Section 80TTA, which pertains to interest earned on your savings bank account, and the maximum limit for the same is Rs 10,000. That means your interest income clubbed together from all of your savings bank account is eligible for deduction up to the limit of Rs 10,000. Most people are unaware of this clause and they do not avail this benefit at all. So kindly note this and implement the same while filing your return. As we move forward, there is one more important and mostly used head of income, and that is income from house property. House being one of the prime asset requirement, people buy this. But usually it is financed with the housing loan. As you are aware, the housing loan is repaid in equated monthly installments throughout the tenure. This repayment consists of two parts, principal and interest component. The interest paid on such housing loan is eligible for deduction from the income from house property under Section 24. The maximum limit for this deduction is up to Rs 2 lakhs, if the property is self-occupied. However, if the property is not self-occupied, then the maximum limit is not applicable. An entire interest amount can be claimed as deduction under Section 24. In case the loan is taken for under construction property and the construction is not completed in 5 years from the loan taken, the maximum deduction limit of Rs 2 lakhs is reduced to Rs 30,000 only. The other component of repayment is principal, which is eligible for deduction under Section 80C. We have discussed this earlier. So, Now, with understanding of these income tax implications, you will be ready to accommodate the tax outflow and plan your budget accordingly. Hope you liked this video and found useful. If so, please do give me a like, which will encourage me to do more such videos. Please do share the same with your friends and relatives and do subscribe my channel, if you like the same. Friends, in the next video, we will discuss all about retirement fund. Thank you and bye for now, till we meet again in the next video.